I'm Christopher Eady. I'm the chair of the Developers Den Organizing Committee, and I'll be your MC for the final round and for the awards reception. Today began with 12 teams from 6 different business schools and real estate programs across Canada and the United States. They were given a detailed version of the scenario that you were handed on your way in, and they were given a scant 4 hours to prepare a presentation to deliver to our preliminary round judges. Those 12 teams have now been whittled down to a final 3, who in a few minutes will present to you and our esteemed panel of Developers Den judges. I am pleased to welcome our judges today. Please hold your applause for the end. In no particular order, they are 3-time Developers Den judges, Michael Emery, CEO, Allied Properties REIT, and Michael Cooper, President and CEO, Dream Unlimited, and first-time Developers Den judges, Brian Johnson, Chief Operating Officer, Mattamy Homes, Stephen Sender, Managing Director and Industry Head, Real Estate Investment Banking, Scotiabank, and Jim Cochimiglio, Senior Vice President, National Real Estate Group, Business Banking, TD Bank Group. This is where you applaud the judges. Each final round team will be given precisely 8 minutes to deliver their recommendations, plus an additional 7 minutes of questioning by our judges. Max here will serve as the timekeeper, and his word is final. Following the presentation, the audience will head to the executive dining room for the awards reception, while the Developers Den judges prepare their verdict. There are no small stakes here today. Third prize is $1,000. Second prize, $2,000. And a winning team today will take home $5,000. For our American guests, yes, those are Canadian dollars. And you probably should have registered to compete last year when the dollar was at par. These prizes are made possible by the generous and ongoing sponsorship of our founding sponsors of Developers Den, by RealNet Canada and the Altus Group. Thank you very much. And now on to the finalists. First up, Team 4.
How's everybody doing today? We're Team 4, and this is our proposal. So the case overview focuses on Jeff Parisa and really the future of Quartet land development. The main points and questions that they're trying to consider are how to balance the dichotomy between land development and home building, where they get their capital supply from, and what the short and long-term concerns are in the market, and obviously whether they want to stay in Calgary or expand to Edmonton and Saskatchewan. When we looked at the residential markets for all 3 cities, all 3 had a positive outlook. The populations were increasing in every one of them. The unit sales and average sales price were also trending upwards. But if you take a closer look, Edmonton, there's $5.2 billion new construction and development pipeline. And in Saskatchewan, the inventory for residential units was higher than the average rate by 15 to 18%. And this presents a little bit of a problem. In Calgary, on the other hand, there's very low vacancy rental rates, and we believe that will push potential renters to become potential buyers. When you look at the capital supply, when you look at the capital supply, you can either go with the current owners, the institutional investors, or external private capital. The current owners are conservative in their mid to 60s, 50s, and they have a low appetite for risk. On the other hand, institutional investors or private capital, they are willing to take on more risk, so we believe that will create higher returns for ours.
Okay, so let's take a look at the options. Our preferred option is option 1, which is to acquire land in Calgary. We believe that this allows us to focus on our area of expertise, and with slightly denser lots, it will offset the increase in lot prices. This option will also allow us to have more flexibility in terms of whether we want to hold and build houses or sell the lots after we develop. Option 2 warrants further consideration is market expansion basically pushing out into other cities. We believe that we could expand our influence as well as have future growth opportunities. Option 3 is our least viable option, and that is to allow oil prices to recover and wait for new opportunities. As a part of option 1, we decided to take a look at the density mix. What was right for our project? At 6 to 8 units per acre, that's the standard size right now. But we also believe that with increased costs, that may change the standards. At 20 to 25 units per acre, that gets into the multifamily, which is not in line with our strategy. So we believe at 11 to 18 units per acre, that really allows us to have the increased density that offsets higher cost and also increases affordability for our target demographic.
So looking more closely at option 1, which is our preferred option, we decided to continue as an integrated land developer and builder. And this balances out the long-term play of land development as well as the short returns of home building. This option also provides us with the highest returns and capitalizes on the low vacancy rates that are driving a lot of people into our home buying. This also increases the company's dwelling lot supply in the pipeline. However, certain macroeconomic conditions are lowering the Canadian dollar, such as a plunge in oil prices. Municipal governments have slowed down development approvals, and this has the highest cost of land and development, which reduces flexibility down the road.
So looking at the financials, you can see that the land prices on a square foot basis is much higher in Calgary than the other two places. But the selling price are even more considerably higher in Calgary. So looking at the profit, you can see they have a substantially more profitable development in Calgary compared to other places. And with regards to the 30 acres of multifamily, we recommend that we will sell this for a 7.2 million profit. The multifamily is not within the strategy of this company, and it's much more risky than what they want.
So our second option is our second most viable option, and is to expand in another market such as Edmonton and Saskatchewan. This would also diversify our portfolio as well as cater to a growing demographic. This demographic also experiences low vacancy rates and has fewer restrictions on their mortgage lending. Some of the deterrents are there's a lot of new development in the pipeline and a lot of inventory. This is also a new market, so there'll be market risk without familiarity with the local markets, and they'll also experience similar macroeconomic vulnerabilities as Calgary.
So the financials, they have a much lower land price cost in these two places, but the selling price is even more so. So again, looking at the profitable standpoint, they are far more or less viable than Calgary. And the third alternative, it's only a 10% profit, so it's really not worth considering. So Edmonton is really the only one even come close to Calgary.
So our last option and our least viable is to pretty much wait, allow the economy to recover and wait until the real estate market provides better opportunities that are in line with our current investors' mindset. This strategy is mostly conservative and would provide the lowest cost of capital as well as not require any new investors. However, we feel like this will not encourage supply in the future, and this will also, the investors will also have to pay a premium for developed land.
With regards to financials here, this will increase the finance cost for this company, because as this company has over 25 years, taken advantage of the two different business, the mix of business units, they no longer can do so in a couple of years when the land bases are decreasing. So this will, increase cost of finance since they only will eventually have one business unit.
All right, let's take a look at our risks. Our first risk is a prolonged drop in oil prices that may affect employment as well as long-term real estate market values. However, we believe our housing stock appeals to more entry-level buyers, which are traditionally less affected by these market shifts.
The second risk is, the ability to find new institutional investor and eventually private or a private investor. We believe that an institutional investor, such as a pension fund, who requires say 8 to 10% return, will be the perfect fit. They have the long-term view and they will appreciate the business mix, where you have the land development and the house building. And also, since this business also being a very risk-averse business, they will be a perfect fit.
So our final risk is the municipal approval on new communities. If we find the right partners who are focused on long-term capital growth, basically patient capital, we can mitigate this risk. So once again, our recommendation is to stay in Calgary, really focus on our area of expertise on smaller, denser lots to maximize returns.
So looking at the 10-year cash flow statement from option 1, you have basically used the first 7 years of developing the land, the last three to do the construction and the selling.
Thank you.
Question time.
And now we'll have questions from our judges.
All right. Sure, I'll start.
Why not?
Do you worry that you're buying land at peak prices, and what would happen if housing prices drop 20%?
Yeah, with regards to the oil prices, history has shown that when the oil prices drops, they will bounce back again after, 1-2 years. So that's what we are assuming that will happen this time as well. So based on the last 5-10 example of when the oil prices have dropped, they will rise again and reach the previous levels.
And as you can see, we based our cash flow on a very conservative level. This is based on a density of 8 units, but what we are actually trying to do is base our cash flows on 15 units per acre. So I think by being a little bit more conservative, we're going to be able to weather the storm, and it's such a long-term strategy. We believe in 5 to 8 years, when it is developed, any economic events will kind of blow over.
Thank you.
So I'm looking at this, and your property level IRR of 8.23%, doesn't that strike you as a little low for a long-term residential land development play? Do you guys think that's a reasonable return that's saleable to investors?
We think it's a reasonable return because it's unlevered. If that's been levered to reasonable standards, it would probably be in the mid-20s, because this assumes that we are only developing 7 units per acre. We are actually, in our base case, developing 15 units per acre, which will give a unlevered IRR of almost 20%. So if we lever those almost 20%, it will be in the mid-20s.
So this is our base case. This is our most conservative estimate.
So can I ask a question on sources of financing? Just give us a little bit of your thinking.
You're a banker.
I'm a banker.
Scotia Bank, in case
you got it. You're richer than you think, right? So, so the question is, you spoke about this being an unlevered return. Give us what your thinking would be as to how much equity you would raise, how much debt you would raise, and if it's equity, what percentage of the company you'd be selling. Maybe you just want to give us some.
We are thinking that we will, since we want to attract the pension fund, we will probably have a loan to value of 50%, and this will attract returns for IRR in the mid-20s, and we don't want to go over. We want to have a conservative loan to value, because we want to have this conservative investor, which is have the same alignment as our company, which also are pretty conservative.
How did you deal with the increase of costs or decrease of costs and revenues over time on the sale of the lots?
We have kept it on the same level to be conservative.
How do you service the debt?
This is unlevered.
No, but assuming you use 50% leverage, how do you service the debt?
Scotiabank.
You're not as rich as you think.
No, then we go to TD.
Yeah, I mean, if you have a loan to value of 50%, it shouldn't be a problem to service the debt.
Yeah, but you've got interest costs you're incurring.
Yeah,
so-
with what, though?
Yeah.
What's the source of funds?
So, exactly. One thing he didn't point out, I think he talked about a little bit earlier, was we plan to sell off the multifamily component, which is about 30 acres after we develop. Along with, we're doing both an integrated strategy where we are developing land and we're also building homes. So we continue to keep building homes during this period of time to make our short-term profits.
Okay.
I would also like to add that if this shouldn't be a viable option, we will always have the opportunity to sell land in during that period of 0 to 7 years, as the market is pretty hot.
Based on the work you did, how do you like the land and housing business?
Why do you ask?
I don't know. Have you guys done land and housing work before? Have you? Like, I just think it's an interesting business. Curious what your impression of the industry is.
I think with Calgary, there is a need for land, and one of the things that kind of attracted us to staying in our home is the high barriers to entry. Whereas if you move out into Saskatchewan, some of these other places, sure, land is cheap, but the barriers are so low, you can't really, I don't know how you would be able to retain the value, really. So that's kind of what we're banking on.
So why don't all the guys that are in Saskatchewan go invest in Calgary? Like you seem to be saying that you don't believe in efficient markets, that these huge I mean, the numbers sort of, so I'm scratching my head saying, how did you get this? Like 10.7 versus 33.9.
Well, some of the numbers that we came up with, especially for purchasing the land, were from recent market reports.
Yeah, the land prices were from an average of municipal sources on available land for residential development.
And we got talk about the sales prices.
Yeah, the sales prices we got from the RE/MAX report, Outlook 2015.
You should know that when we all started, everything was really, really cheap, and there's hardly anybody in the industry. So I'm not sure what we would propose now.
Thank God we started when we did.
This looks hard.
Yeah.
Last question.
Do you think the company has the physical infrastructure to grow this much? Because this is a huge leap in the size of the company.
I mean, with the alignment of a large pension fund, who knows very much the financial market, who has the knowledge and expertise. You have our company who have the local knowledge. They have the more knowledge of the macro market and the finance market that we believe, and they also have the same appetite for risk. We believe that will be a very good fit.
I'd like to add, also, this company has always been on the sponsor, the GP side. So staying in Calgary allows them to continue to grow their company in a similar strategy, whereas moving to other places may not give them the opportunity. They would have to take on local partners who would then have control.
Thank you, Team 4.
Thank you. Thank you.
Don't listen to that about no barriers in Saskatchewan.
Yeah.
Just even a different look.
You're going to like this one.
I would like to welcome Team 12 to the stage.
Good. Good afternoon, everyone. Thank you all for being here today. We are Team 12. We are very excited to be here today to present to you what we believe is the best strategic direction for the future of Quartet. Our assessment will take you through the key highlights, some guiding principles, and the different alternative. Then we will take you through our final recommendation and conclude with our implementation plan. So let's get right to the point here. We recommend that Quartet continues land development business in Calgary, specifically by partnering with a non-Calgary-based developer to raise equity and reduce risk. The criteria that we use to evaluate our alternative is market fundamentals, specifically the economic and industry environment. Then we looked at management. What's their risk appetite like, and where does their current expertise lies? And then we looked at their overall strategic direction.
So the first alternative that we considered is the status quo, or Quartet just standing on the sidelines. There are a couple of pros to this alternative. For one, it aligns very well with their risk appetite and would also allow the management to focus on their core competency of building homes. There are some risks, however. For one, the current business model is not sustainable. In 4 years, Quartet will run out of land. Currently, Quartet does control some of its supply. However, if it sticks with the status quo, this will not be sustainable. And if it chooses to acquire land in the future to fuel its building segment, it may need to do so at market prices, which is currently not ideal as Calgary land prices continue to rise. The second alternative that we considered is expansion outside of Calgary. We focus primarily on Edmonton. The unlevered IRR and levered IRR are high, and they're also, Edmonton is poised to benefit from strong market fundamentals. Employment and population growth is expected to support demand of housing, and there's also likely to be less competition for acquiring land as service relative to Calgary. However, there are cons. As we know, development is a local business based on relationships. Since Quartet does not have any local relationships with regulatory bodies or local trades in Edmonton, this may pose some disadvantages.
Thanks. So I'm now going to talk about the third alternative, which is the foundation of our recommendation, and that is the Calgary expansion. So when we look at the IRR from a levered and unlevered basis, you can see it's quite high. The primary reasons for that are a few. When we look at it from a demand perspective, single-family homes continue to drive demand in Calgary. Furthermore, from a land and supply perspective, land continues to be very scarce and continues to drive up price. One of the most important advantages for Quartet is their local market knowledge. They have regulatory, government, as well as trades expertise, which will ultimately expedite approvals and get the development going. Finally, when we look at their integrative business approach, purchasing this land will continue to stockpile their land for future developments and allow them to continue to build. However, as we know, Calgary is a very volatile and economic market right now, primarily driven by the oil. This does have the potential to cause some corrections within the housing market in Calgary and is a risk we should be aware of. More importantly, from the fundamental numbers we were provided, this IRR representation is based on an 80% loan-to-value ratio. When we look at Quartet and we look at the management and shareholder objectives, we truly feel that this loan-to-value is too high. Therefore, we would recommend they revise their loan-to-value. However, we must recognize that this will lower the IRR. If we flip to the next slide, we'll see our financial model. And just a few things to call out here. The development period in terms of the land servicing is 6 years. We then have a 2-year build out. And if I can direct your attention to the bottom chart there on the top, the right column specifically, this is where we really see the development truly stabilizing. As you can see, a very strong IRR from an unlevered and levered perspective. And from a housing typology standpoint, it's 70% single-family home and 30% stacked. Based on our analysis of the market, this is where we see Calgary continuing to drive the demand for their household. Finally, again, just to reiterate, from a loan-to-value perspective, if we do end up proceeding with this as is, we are looking at 80%. However, these would be lower if the loan-to-value ratio was reduced. I'll now pass it over to my colleague to conclude.
Okay, so now we're going to talk about the capital structure. There you go. And so we're talking about the capital structure from the point of view that my colleague spoke about, so the 80% loan to value. So there's some obvious there's some obvious pros with this. We're able to have a very high return. As you saw, our unlevered returns were very high in comparison to the project returns. As well, we can use the equity that we save by using more debt for other projects or to provide dividends for our equity partners, which is something they are very interested in. The major con, really, is the risk that comes with debt. So having this much debt is not something that many developers look towards. As well, it just means that you're going to have heightened losses if you have issues with the project. And knowing that development of land can be a very risky endeavor, this can be an issue. So next is the recommendation. So as we stated before, we want to go with land acquisition in Calgary. We feel this mixes right with the risk profile of the management, as well as providing stable returns, actually very good returns, and very comparable to any other option. We want to partner with someone who's outside of our market segment, and this will allow us to mitigate risk. And since we don't have very much cash currently, it'll allow us to build up the cash that we need in order to get this project done. As well, it will allow us to continue with integration of the having land development as well as being a home builder, which is something we discussed before as being a very good in this market. And finally, I'm going to talk about the implementation plan. So immediately, we're going to do some due diligence on the land acquisition that we have. As well, we're going to find the equity that we need from our partners, as we mentioned before, and institutional investors. Finally, in years 1 to 5, we're going to look to service the land and then be able to actually turn it into for home builders and be able to use this land as part of our business. And then finally, in 5+ years, we look forward to reassessing with you where the business is going and determining what's right, considering the market, considering where we're going, and just figuring out what's right for the business moving forward. Now we welcome any questions.
Very well done. That's good. How the fuck do you
So the first question I just want to ask you, why a non-local developer?
Sure, take that. So the reason we thought we would go with a non-local developer is from a competitive standpoint, we thought approaching developers who are actively developing in our market would be a little bit of a tougher sell to go in a JV directly with them. And we felt that the what's in it for the non-local developer is exposure into the Calgary market. So the names we had specifically up there, 100% of their developments were out of market. So we thought this would provide them a great diversification opportunity and allow us to generate the equity required to go through with the project.
Yeah, I got a question. You identified a lot of risks. What are the 1 or 2 key risks, the ones you worry about the most that could derail your plan?
Yeah, I mean, at this point, I think the leverage was one of our biggest issues. This was an assumption that we took from the case. We think 80% is very high, especially given that it's a very, very risky endeavor to acquire the land and develop the land. You don't know, maybe for some reason it's not serviceable. You're not going to get cash flows for, we had down 6 years as the horizon until we get cash flows. So for us, that was one of the major risks that we saw.
Can you just explain the difference between option 1 and option 3?
If we go back, do you mean?
Yeah.
Yeah, sure. Do you want to go back?
Calgary expansion.
Yeah,
and
so option
one.
1's Calgary expansion and continuing to be in the land development.
Right, and then
as
option...
opposed to option 1 is just status quo, and then in 4 years, we'd actually run out of land to develop.
Okay.
So at that point, we'd really be focusing on building the homes, yeah. So just not integrating at all.
Okay, so that's just the build-out scenario is what you're saying?
It's just the option of just status quo, sit on the sidelines.
Okay. Can you flip to your pro forma? Is that, do you have development in year 1? Servicing of $24 million?
Yes. So that's the servicing fee we received. Given the time constraint we had, we made the assumption that that would be over the year 1 to 6. It would be evenly spread over the time.
Oh, so you're assuming you're going to start development right away?
In terms of land servicing, yes, we did assume that.
No.
These are communities. You did a lot of math. How are you going to win with what you think about creating?
You know, I think in terms of what we're creating, I think the key element for us there was really looking at what the market really needs, and that was really spacious single-family homes, as well as the opportunity to integrate the stacked homes. So from a profit standpoint, if we had done just pure single-family homes, we probably could have had an even stronger IRR. So we feel we're really bringing something to the community that they really need.
Yeah, and then just to add to that, the stacked homes are going to play a big importance in the market. We were looking at demographics, particularly seniors, and there seems to be a clear need for one-floor homes where seniors can have everything accessible. So that was also a key consideration.
I mean, just the business is a fantastic, creative business that changes people's lives. And in real life, trying to figure out how what you're designing is something that's really important to the city and the people that live there will get you approvals faster, higher revenues, and better margins. So just, in real life, it's a lot more fun than this.
You guys said that you were concerned that you wanted to buy now because land prices will spike when oil prices recover. Wouldn't it be a different way of looking at it, saying, am I buying too soon because prices have dropped for oil, and I'm buying kind of at yesterday's price for land at in an environment where oil prices are half of what they used to be? Wouldn't you sort of think of it the other way? Like, is this not the wrong time to be buying all this land?
Yeah, that's a good point. We would pretty much base that assumption. We were just looking at some articles on the Calgary Herald, and there seems to be a lot of almost speculation, and they're saying that there's not a lot of serviceable land lots right now in Calgary, and they're trying to implement some kind of way to count them, and it seems that there just was a big demand, and prices were going up a lot almost every month. So that's kind of what we based our assumption on.
So one other point to add to that, I think, you know, one of the key components that we found interesting with this market is obviously the volatility in which it operates, given its commodity-driven economy. So we felt, knowing that if we continue developments as we're proceeding, in 4 years, we will be at the mercy of the market. So if, in fact, your comment is correct, we would have to purchase at a premium from the market. This purchase today gives us the option in the future on how much and when we develop. So that was another key consideration, that in order to continue the integrative process, if we don't make this acquisition now, in 4 years we're out of land anyways. So we're really at the mercy of the market at that point. So that was something else we considered as well.
Did you make any assumptions about the cash that comes in from the runoff of the existing land, and whether you could reasonably afford to do the whole project yourselves?
So based on the income statement and financials that we were provided, we felt we wouldn't be able to do it ourselves. And I think the second reason also, we looked at the management and the ownership, and they were approaching their 50s and 60s, and they were even thinking about potentially exiting the business.
Those are wonderful years. And very, very pro-risk.
Pro-risk?
Totally, yeah.
So that was another consideration for us. But.
Michael, you're old. Let's be honest.
That was a statement, and thank you very much.
Michael Cooper, by the way.
Oh yeah, no, yeah.
Isn't that interesting?
And that's what our clients do, right? Yeah, they're both. That's what you guys do, right? Yes, sir. I'm trying to try to
And now the final of the finalists, Team 5.
Thank you, Chris. Do you mind clicking, Jared?
Yeah.
Okay. Good afternoon, and thank you for joining us for our presentation. Today we'll examine the various options available to Quartet Development as it evaluates its strategic direction, something we like to call Quartet's Quandary. Our presentation today is split into two components, strategy and opportunities. First, we'll evaluate the current strategy and provide our recommendations for revisions to that strategy, and we'll also look at some internal metrics on Quartet. The opportunities section of our presentation examines the Calgary land development opportunity and also looks at a high-level review of Saskatchewan and Edmonton opportunities. As we look at Quartet's current strategy, they're trying to find the balance between long window, capital-intense land development and short-term, lower-return home building. And after 25 years, it's hard to say, but there is no clear strategy. 1/3 of developable land comes from internal sources, 1/3 is purchased, and 1/3 comes from equity partnerships. Without a consistent strategy, it's led to volatile returns, income returns going from 14.8% in 2011 to 6.7% in 2013, and back up to 9.1% in 2015. We believe the volatility in these returns is a result of unsteady equity land partnerships and increasing land and construction costs that have not been offset by revenue increases. As the Alberta housing market faces uncertainty, now is a great time for Quartet to revisit its strategy and, most importantly, its capital structure. Historically, the company has primarily completed projects using internal capital. This reliance on internal capital has limited their ability to realize upon opportunities as they become available. The majority of equity is actually tied up in WIP and inventory. And the days in inventory has gone from 225 in 2011 to 301 in 2015. This highlights the fact that while equity is tied up in these assets, they are not able to mobilize on great opportunities as they become available. And we'll explore that later in the Calgary land development. I'll now pass it off to my partner, who's going to talk about how we're going to revise this strategy.
You got to push it to the wall. Okay, so looking forward here, we're looking at our new revised strategy, and how we're going to do that is really take a vertically integrated approach. Investors must be prepared to be patient when looking for returns. This strategy is much more capital intensive. And what we're going to do here is we're going to launch a new fund that will allow Quartet to mitigate risk, reduce their equity exposure, and maintain the current ownership structure. Next slide. Looking at the process, the launch of the GCA fund will allow investors to take part in land acquisition and residential development. Next slide. When we're looking at long-term investment criteria, we have a number of studies that we need to conduct. One is that we need to ensure that we're close to infrastructure, that we have municipal governments behind us, and that we have schools, community centers, and public transportation adjacent to land that we are looking to acquire. Looking at the internal analysis of the company, you can see on the chart, as my teammate mentioned, there is volatility over the 5-year period. Looking at this 5-year period, we can see that the land development has had a higher return over home building. Sorry, home building has had a higher return over land development. What we plan on doing through our vertically integrated process is creating a much more stabilized return that will allow for a streamlined process that can create both home building and land development to be much more consistent. Looking forward over the Calgary development, I'm going to now pass it over to my teammate.
Okay, here's how we're going to apply our strategy, structuring and sourcing the deal, specifically in the Calgary city. From the left side, basically we're going to suggest Quartet, to acquire the land, then build properties on it, and sell them more. This arrangement requires an extra $500 million in the left side. To finance this increased part, we're going to pursue a construction loan with less than 50% LTV ratio, which is a rate we believe is profitable to the company and also conservative and secure to the debt holders. Next to the construction loan, the fund we're going to launch will also provide a quarter of the cost we need. And lastly, we're going to finance the project from the proceeds of pre-sale our properties in the future. And although the total cost almost doubled by arranging like this, we do have some external backups to that, so I'm going to pass to Edwin.
Our group first looked at the Calgary market. Although the CMHC report doesn't account for the oil price decline recently, we feel like the market is cyclical and the market will bounce back eventually. It also indicated that there's a short-term decline in multifamily residents, but will eventually normalize. Also, according to Appendix C, the net lot availability will be declining over the next 3 years, but eventually there will be an upward trend. We feel it is important to also look at the other markets in the area. Next is the Edmonton market. They're experiencing historically high migration rates, and the labor market is doing well. The market is also minorly affected by negative economic activity, but it is smaller than the Calgary market. We feel like this is a long-term potential investment opportunity. Next, we looked at Saskatoon and Regina. We feel like they provide a similar story. They're both commodity-based cities, and as the U.S. economy recovers, the housing market and labor market will rise. But it is not a strong market at this time. Overall, between all the cities, we feel like Calgary is the strongest market to invest in, and I'll leave it up to Elvis to wrap up our Calgary project.
Thanks. Based upon all the information available, we broke down the properties into 3 types of property. First, 50% our deliverables will be the single family, and the 30 will be stacked townhouses, and the rest will be smaller single families. And we believe this combination covers a universe market demand and also keeps the leads change to the original plan. And according to our revenue projection, we're going to bring up the return on revenue and the return on cost by 3% and 4% respectively, and which is also a conservative projection because we didn't apply any crazy assumptions on that. And to sum up, we believe we hope that. Okay. Sorry.
Could you complete your summary?
I think you guys are typical developers. You're going big. You took this little land acquisition and turned it into some big, huge fund. So were you planning on rolling in the corporate assets into this fund, or were you just going to do it on land acquisitions?
We were going to keep it a separate entity.
Okay. And so where does the $200 million of equity come from?
Well, from the case, we saw that there was strong demand from institutional investors and private net worth investors, so we would raise that externally.
You mentioned
we would also apply 30% of Quartet's capital in that fund, so we'd have skin in the game.
You mentioned that investors must be patient. They typically aren't, of course. But I couldn't discern from what you said what the investors will get out of this.
So the fund is a closed-end fund. It will be a 5 to 8 year fund. The return on the fund is expected or projected to be 9 to 12%. Is there anything else?
That's a return on equity?
That's return on equity.
Do you think that's enough?
That's more than patient.
Although the returns overall in this case are low compared to real life. And in this world, probably interest rates are -1 and REITs are yield 2. So it's a great return.
Good point.
That's taking a conservative approach. I mean, our returns on the investment, that the Calgary investment, is much higher.
So what would the return for your client, if you will, be in relation to the return for the investors? I forget the name of the company, but...
Quartet.
Yeah, Quartet. What's Quartet's return as compared to the return provided to the investors?
Quartet is receiving a management fee for managing the fund, as well as receiving a hurdle return based on...
But you have any idea in terms of the relationship? Are they profiting wildly while the investors are just getting 8 to 9%?
No, really, we see the launch of this fund as not more so as a way for Quartet to profit from management fees. We see it as a way for Quartet to mitigate the risk and allow them to invest in opportunities that they would otherwise not be able to invest in.
How would you deal with the conflict between the two? You've got a fund on the one hand with other investors, and you have your own business. Like, where does the land, is Quartet going to buy the land from the fund? Is that how it's going to work?
No, the fund sources the land separately. There's no fiduciary issues concerning Quartet and the fund. They're not going to be acquiring land from Quartet. They'll be acquiring it from an outside source.
Who's the customer for the fund? Like, who are you selling to?
From the case,
is that with CAI?
Yeah, that's what you, no, CASE.
Are you guys Canadian? Case to default.
No.
So you're just selling land? That's what I was trying to ask, right? Are you selling service lots? Is that what you're doing?
Yeah.
You're developing lots, and who's buying these lots? Would Quartet buy the lots?
Oh, so you're asking about the end user.
Right.
So the end user, we see there could be a variety of different investors in that. So we're opening it to the public.
But would the investors participate in the land development as well as the housing profit? Is that all being done within the closed-end fund?
Yeah, I think we talked a lot about that part, because that was the consideration of if, okay, the land development is a 5 to 8 year window, the home construction is 5 months to a year, and we were talking about doing a phased approach. But yeah, our initial thought was that they would just participate in the land return, but then we also considered what would happen if they participated as well in the home equity or the profits from the home development. But I think at the end of the day, we were looking at it as being a land development fund, and then selling the product through Quartet, so that Quartet would get that vertical integration of doing the land development plus the home construction and the sales to the third parties. But it's an issue we haven't 100% because there was limited information, but we felt more that the kind of investors we were looking for would be land development investors, longer term window, 5 to 8 year return versus that 5, 6 months to a year return on the home construction.
We tell them land development and housing is much more profitable now, or wait.
Yeah.
You get to use the money many times. I think each of the groups are assuming that you need all the money and you use it once. We rotate. You collect deposits. You don't have to pay for the servicing until. So the amount of capital that's needed for this is a lot less than all the presentations. It's a pretty robust business. I doubt you need as much capital as you guys are using.
Yeah, unlike a lot of people looking for money, you didn't put inflation in your projections. Like a lot of people going out to look for money put inflation, and they say to the sky, it's 5%. Trust me on that point, and that's how they make these numbers look ridiculously high in the returns. You guys are too honest. I think that's the problem.
So you did think about phasing it?
Yeah, so yeah, it may not have reflected in the structure there, but we did talk about doing a phased approach, maybe 500 and 500, because we were worried about supply and oversupply, and so we wanted to make sure we didn't just go out and build 1,500, or I think we had 2,100 units straight away on spec. So we wanted to do a phased approach to the land development. So you are right that I think in our structure here, we may have, the fund itself was looking at the longer term at the whole horizon, but we may actually do it in tranches. We may not actually go out and say we need, I think we say 200 million straight away. It may be, a 75 million tranche and then another 75 and then the balance. So that was kind of the approach, was that, yeah, we felt that from deposits and pre-sales, we could also finance the future sales in the project. But for the deal structuring here, this is kind of how we presented it. But there was a phased approach to the project.
When you do this, do you use debt when you're...
So what happens with Quartet at the end of the fund? Because it's going to run out of land.
Yeah, so guys, the plan that we looked at was that there'd be continual opportunities and there'd be future funds. This was just a closed-end fund for this project in this opportunity. We also wanted to look at Edmonton, Saskatchewan, Regina, other projects. The plan long-term for Quartet is that there's a consistent kind of pipeline of land development coming through. So that there's not just this one project and it doesn't just fade away. It's that there's a consistent kind of projects in phase. So I think we looked at, like, you know, if we could have 1 year worth of development always at the ready. Now, I mean, it's difficult because they are transitioning from a strategy where it's kind of a hodgepodge of buying land here, equity partnerships here, to this more integrated strategy with the fund. So there will be that kind of growing pain as they transition through that period. But our hope was that we would look at doing other funds in other markets. And maybe it's in Calgary, but Edmonton looked like another potential market for another fund. So there'd be multiple projects happening at the once. But it's structuring will be a concern.
You referred to volatility as negative when you talked about how Quartet operates now. How do you take the volatility out of housing?
That's a good question. I think one way we looked at it was through phasing. So when looking at this development, we really wanted to say, okay, are we going to launch and provide 2,000 new units to the market all at once? And how is that going to impact the market? How's that? Is there demand? So phasing, I guess, would be the answer, the short answer.
I only say it because we missed on our third quarter numbers by 50%, and in the fourth quarter we were about 40% above it. So it looks nice, smoothing out construction and housing prices and demand. Looks nice. It's very good.
I can ask one more question. How do you know you're going to get 2,000 approvals from the city?
I mean, this process takes a long time, and we've accounted for that. So we don't know for certain that we will, but we've allotted time for that reason.
So do you have any cash on the purchase price?
Yeah, was that?
Was it all cash at the purchase price?
It's time. Cash, yes. Yeah. Cash on land, yeah.
Thank you. Thank you.
Good work, guys.
We have one final round of applause for our 3 finalists today. So I would like to invite all of our guests now to move to the executive dining room where we have a nice awards reception set up and ready for you. While our Developers Den judges remain here for the next half hour to consider their final verdict, which you will learn at 6:30.